recorded. I am recording it, I should say. It should be up in the archives later next week, Doug. All right, swing real quick. Let me just show you what I mean. This is actually technically not what I call a long strangle. It gives me a similar profit and loss chart to a long strangle. But when I think of a long strangle, let me show you what I mean. Let me go into the other strategies. Let me clear out some of my credit spreads here. I'll enter, let me just do this, long strangle and short strangle just for now, okay? And I'll save that. And there's two different strangles. You can be long or you can be short. A long strangle is, here we are. You see over on the right-hand side of the main page there. This is the profit and loss chart of a long strangle. Okay, but typically when I'm doing a long strangle, what we just looked at is buying an in-the-money put option and buying an in-the-money call option, speculating on a movement in price. Oh, this must be one of my special searches here. Hold on one second. Let me do earnings surprise. I'm just going to change the default search real quick here to earnings surprise. There we go, okay? So this is looking for positions that have earnings coming up. The first result we see is Whole Foods Market. I'm shown for the January expiration right now. I could buy the 33 strike call for $2.39. Okay, so stock's at 32.06. I'm sorry. So I could buy the out-of-the-money 33 call and the out-of-the-money 32 put for about $2.83. Okay, this will give me the same profit and loss chart, but what have I done here? A typical long strangle is reversed. I'm actually going to buy an out-of-the-money call and an out-of-the-money put. What we were just looking at was using an in-the-money call and an in-the-money put. Still technically a long strangle, but has similar risk-reward profile, but it's subtly different, using the in-the-money strangles compared to the out-of-the-money strangles. What I'm doing with a strangle is I'm expecting the stock to move up in price, but as you can see, the total income, the total ask price for both options is about $522 or $5.22 per share. The stock's right now is at 32. To get my break even, I add 522. I'm not going to write 522. That's going to look so pathetic. And I'm not even pumpkin carving yet. That's later with the niece and nephew, so I'll leave my sloppy art for there. But the 3206, I'd add 522, so my upper break even would be 3728. And then on the downside, it would be at about 2680. So I'd need the stock to drop to 2680 or go above 3766 here in order to make a profit. This is a very, very speculative trade. Okay, long straddles or long strangles are very speculative. Let me close the profit and loss chart. Let's pull up a short strangle. Here we have the same type of risk-reward profile, but we're flipped. Okay, we flipped it. And so what we're doing there is this is called the short strangle. I'm going to short an out-of-the-money put and short an out-of-the-money call. And this is a very dangerous play because essentially you have a naked put and a naked call, and you have a lot of downside risk on either side. Okay. Here we have some limited values. Let's go ahead and take a look at the profit and loss chart for, I'll use Boeing for right now. Let me just go ahead and pull that up. This is a neutral play. See, the other one, the long strangle or the long straddle, is a very aggressive speculative play. We're expecting a wide swing in the market one way or another. This wasn't a good example to use, but in essence, I'll do this. This is your short strangle for Boeing. We're using the 48 and the 47 call and put. Wow, this is just about as risky as you can get, isn't it? You make money only if the stock, well, you can make money. You receive a pretty decent premium up front here. You're taking in about $270 worth of net credit, but you're going to have a high monetary requirement. Why is that? Because essentially you have unlimited risk on the upside. You essentially have a naked call and a naked put here. You make the maximum profit if the stock stays between your two strike prices, in this case 47 and 48. Your lower break even here is typically the put strike price minus the net credit, so it would be around 44.30, and the upper break even is 50.70. So if it goes above $50.70 or below 44.30 at expiration is when you'll lose money. But that curved line here shows you the halfway point, and you see you get a much less break even. It looks like the break even is about $50.25 on the upside and about $45 on the downside. Okay, so that's your short strangle. All right. So, oh, Boeing's going to South Carolina. That's great. I didn't know that, actually. I guess they're opening a new plant there, possibly. Okay. So that's the difference. Now, Swing, I think you've joined me before, and I know some of you online have joined me before in other webinars. During the Introduction to Power Options webinars on Wednesdays, and during the Power Options for Radioactive Trading discussions on Tuesday, and even my main strategy discussions on Thursday night. And I always have this disclaimer. And my disclaimer is always, when I'm introducing myself as the presenter, I let everyone know that I'm versed in all 23 strategies on the site, but I don't trade all 23 different strategies. This is one of the 23 strategies I would never touch and never trade, the short strangle. Too much risk-reward profile for me. I don't like it. I would never want to have essentially a naked call position. Too much risk of getting slaughtered. I trade naked puts, but only on stocks that I want to buy. This is one of those positions where I don't like the risk-reward profile. Let me close this, actually. I don't like that one. Let's choose Apple. It's the 190, 185 short strangle here. Is that what I'm on? Short strangle? Absolutely. Let's take a look at that profit and loss chart real quick. This will give us a much wider view, a much little better screen. There we go. So I got a 5-point difference there, got a wide range. But for me, this is still too much risk. Okay, break-even's at 170, break-even almost hits at 175 here. And on the upside, it's about 200. I'm selling the 185 put and selling the 190 put. I wouldn't enter this trade, but if I was neutral on Apple, a trade that I might enter is turning this into an iron condor. So I've sold the 190 call and a 185 put. To turn this into an iron condor, let's just keep things simple. I don't know what the profit and losses are going to be. Let me look at the November options. What I'll do here is I've sold the 185 put, but at the same time I'm going to buy a 180. And I've sold the 190 call, but at the same time I'm going to buy a 195 call. Essentially what I'm doing is entering into a bull put credit spread and a bear call credit spread. Now, before I hit submit, let's take a look. The initial premium I'd receive for this short strangle is $990. The monetary requirement, we've based this on what some of the brokers use for their margin requirements of being short a naked call and short a naked put at the same time. So let's assume our margin requirement was about $37,500. Max risk is infinite. We can't forget that. The maximum risk is infinite with a short strangle, and the maximum return is only about 2.7%. This $37,000 we'd probably have to have on hold in our brokerage account in order to even place this trade. Okay, so that would be a lot of money to have on hold to make $990. 2.7%, that's almost like trading a covered call, isn't it? But let me convert this into the iron condor trade by adding an outside call leg and an outside put leg. All right, now we have a little bit different profit and loss chart. I'm still risking a fair amount. I've cut my maximum profit, my monetary profit down from $990 down to $345, okay? Because I had to buy the call and buy the put, what total credit I receive is now $345 instead of $990. But because I only have a 5-point difference in spreads between the 190 call and the 195 and the 185 put and the 180, I've greatly reduced my requirement. I'm only required to maybe have $1,000 on hold in my account to place this trade. Now, my maximum risk is still pretty high. It's higher than I like to take on any position. It's about 24%. I can lose $155 off the standard investment there. That gives me a 24% risk. But notice how the return, not the monetary maximum profit, but the percentage return is much higher. Okay? Because technically the total monetary requirement is only $655. I can make $345 off of that investment of $655. That's a potential return of 52.7% of my margin amount. Okay? So I reduced the total premium I could receive. I reduced the total monetary amount I could receive to $345, but I only have a monetary requirement of about $655, not $37,000. So if I'm interested in playing a neutral play such as this, I'm not doing that short strangle anyway. I'm looking at doing an iron condor trade. Okay, and this gives me a good prelude to introduce that most likely next Thursday night, November, believe it is the 5th, if I'm not mistaken, Thursday, November 5th at 6 p.m. The next strategy discussion we're going to have is going to be introducing iron condors as sort of a teaser